Hi, I'm Jimmy. In this video, we're looking at what's commonly known as the Santa Claus rally. Is it a real thing? Now, for those that aren't too familiar with the Santa Claus rally, well, back in the early 1970s, the Stock Traders Almanac published an article stating that the last 5 days of any year, plus the first 2 days of the next year, are likely to show the stock market rallying. They affectionately called this rally the Santa Claus rally. So let's jump in and see if it's true, and then we'll see if we can learn anything from it. Okay, so the theory behind the stock market running higher during the Santa Claus rally is that maybe investors are expecting a strong January. Oftentimes they call this the January effect. Or perhaps there's lighter volume in the markets because there's so many people on vacation. So in theory, it's easier for the stock market to run higher towards the end of the year, right around when Christmas is happening. Put another way, people aren't really sure why it's happening, but in many circles, a lot of people rely on it. So in that 1972 Stock Traders Almanac article, their analysis went back to the 1950s. So I thought it would make sense for our analysis to do the same thing. So this is the performance of the S&P 500 during the Santa Claus rallies going all the way back to 1950. And as we could see, there are a lot of green lines in each of these charts. That tells us that during these 7 trading days, well, it seems that the S&P 500 does in fact do quite well. So perhaps the Santa Claus rally is a real thing. Sure, there were some patches where there were a few red lines where the Santa Claus rally didn't hold up. But all in all, during the 69 years that we saw in this analysis, the Santa Claus rally has posted a positive return 50 out of the 69 times. That's about 72% of the time. Now, my question was, can we use this information in a useful manner? And is that 72% actually a good number? It sounds good, but how good is it? Well, to try to find some sort of pattern, I added the total return of the S&P 500 to each of the years following the Santa Claus rally. So, just as one example, if we start around the Christmas of 1968, well, we can see that in that particular year, the Santa Claus rally saw a decline of about 1% during those 7 days. And that led to a total return the following year of a negative 8.4% return. Then when we jumped down to 1977, we saw a very similar story. The Santa Claus rally posted a negative return of 0.3%, and that resulted in a 7.2% loss for the following year. Now, I've actually heard that this is one of the real benefits of the Santa Claus rally in that it can help predict a bad year. But you may notice what I noticed, and that is that there are plenty of examples where we saw a negative Santa Claus rally, but the stock market posted a positive return for the following year. So that argument doesn't hold water in my opinion. Now, this brings us back to the fact that 72% of the time, the 5 trading days at the end of the year and the first 2 trading days of the following year do result in positive numbers. But we may notice that there's an awful lot of green on the S&P 500 side of this as well. We had 19 Santa Claus rallies that showed negative returns. We only had 15 S&P 500 years that showed negative returns. So is the Santa Claus rally really a thing, or is it the result of just having a really good stock market since 1950? Now, I suppose that this is a tricky answer to come up with based solely on this information. It does seem that the Santa Claus rally does properly identify a particular week in the stock market that the stock market seems to consistently rally. And given that information, I suppose that can help us in at least one way. And that is that if we want to buy a particular stock, well, maybe it makes sense to buy it before the last 5 trading days of any year. And if we do that, well, at least we can approximately estimate that we have a 72% chance of the stock market rallying before the first week of January is done, which I suppose is a decent piece of information for us to have. Now, another thought that I had is, do we see any patterns with this when a really strong stock market happens? So, as we can see so far here, in 2019, with just a couple weeks remaining, well, the S&P 500 is up more than 25% so far. So I went down and looked for where we had a greater than 25% total return for any given year. Out of all of these years, 15 years showed a greater than 25% total return. Of those 15 years, 14 of them were followed by a positive Santa Claus rally at the end of the year. That's a 93% success rate. So once again, this could confirm our belief that if we're considering getting into a position, it could make sense to get into that position at least 5 trading days before the end of the year. since during this year we're already up more than 25%, so perhaps we do get a Santa Claus rally to work in our favor. Now, on a personal basis, I'm actually a bigger fan of letting the price of a stock do the talking for us. I'm a bit skeptical of the concept of at a certain time of the year they always sell off. That seems true until it one day no longer does that. But if we look at last year, just as an example, if we take the Santa Claus rally from the end of last year, this is what the Santa Claus rally looked like. It was up about 100 points during this time, which is about 4% during this 7-day time period. But when we switch to the full month of December, well, last year's Santa Claus rally began right there, which is a very fortunate day to begin investing. So this 4% rally in this Santa Claus rally might have been a bit skewed. Now, this might be somewhat of an irrelevant point. Perhaps it was, in fact, the Santa Claus rally that caused the stock market to begin to rally at that point. I remember December being a bad month, and if we got invested at that point, good for us. That was amazing. I personally just have a little bit of trouble relying on that. Now, if you're curious when I think is a good time to buy a stock, this could be a good next video to watch. In that video, I dive more into how to identify a margin of safety based on the intrinsic value of the company. What's the true worth of that company? So there's a link here. There's a link in the description below. Besides that, thank you so much for sticking with me all the way into the video. I hope you found this video interesting. And now we all know what the Santa Claus rally is. And if you have any ideas, any patterns perhaps that I didn't see, please put them in the comments below. Don't forget, hit the thumbs up, hit the subscribe button. I appreciate you sticking with me. Thanks. I'll see you in the next video.